Thank you for joining us. I'm Jimmy. Presenting with me are Jeff, Reed, and Roxy. We'll be discussing American Barrick's hedging practices for the past decade and providing our recommendation for future hedging strategies. We will start by giving a little industry background, including discussion of Barrick's competitive advantages in the value chain with special attention to Barrick's financing programs. Next, we'll delve a little more deeply into the risk management program at Barrick and all the different hedging tools used by the company. We'll then examine Barrick's success and present our case for a recommendation that Barrick should continue to use hedging in the future.
American Barrick Resources Corporation is a gold mining company based out of Toronto that experienced great success in the 1980s and into the early 1990s. This success came from several strategic acquisitions, smart hedging strategies, and a bit of luck. To give you some background on the industry and Barrick's position in it, we're going to take a look at the industry value chain. The four phases of the value chain for a gold mining company are exploration, acquisition, developing the mining process, and finally, selling the gold in the market. American Barrick was able to develop a competitive advantage in three of the four phases of the value chain: acquisition, development of the mining process, and selling gold. Furthermore, Barrick used these advantages to create a positive feedback loops where an advantage in one phase could enhance a competitive advantage in another phase. Peter Monk was the successful Canadian entrepreneur and financier that founded American Barrick. He surrounded himself with talent and was able to acquire productive minds and develop a business model that built a strong foundation for American Barrick. By hedging production to reduce price risk, Barrick was able to lock in higher than market returns for the company. This moderation in the size and timing of cash flows achieved cash flow consistency, which, in turn, allowed the company to continue to make investments in production. Thus, Barrick had the capital to continue to acquire mines. While good fortune played a key role in the extremely profitable nature of the company, such as when reserves on the acquired Mercer mine property proved almost 20 million ounces richer than initially estimated, this was only one piece of why the company was successful. The continued acquisitions also brought in human capital that helped enhance the mining process. When Barrick acquired the Camflo mine, it acquired with it talented technical and engineering staff that enhanced the mining process and nearly tripled its reserve base with the acquisition. While American Barrick did not have a clear advantage in the exploration phase of the value chain, it made up for this with its ability to acquire productive mines.
American Barrick CEO Peter Monk was motivated to establish a conservative hedging strategy largely in part due to a failed prior business experience. A business failure, likely due to high debt leverage, led Monk to focus on moderating American Barrick's price risk, leading to consistent and expected cash inflows, while lowering the need to carry high debt amounts during periods of depressed gold price. By executing this strategy, American Barrick would be able to take advantage of capital expenditures at any time, regardless of the current gold price, a fact that is important in an acquisition-heavy industry like gold. In order to limit American Barrick's exposures, Monk organized different mechanisms. The first mechanism used was a gold trust, used to raise capital to develop mines. The gold trust mitigated the risk of production by paying a percentage of output as opposed to a fixed dollar figure, as well as price risk by paying a higher percentage to investors as the price of gold increased. This deemed attractive to investors as they were able to benefit from both increased output and the gold price. Another tool used were bullion loans. To raise capital funds, American Barrick would borrow a mass of gold from a bank and immediately liquidate the gold at the market price. This tool allowed American Barrick to essentially lock in the current price of gold, as the loan was paid back by delivering gold at a rate of interest in the following years, with the mine serving as collateral in the interim. This technique hedged against downside price risk, as it would prove to be beneficial if the price of gold were expected to go down in the future. Similarly, American Barrick used gold index notes, which acted as a put option bond for investors. This tool also mitigated price risk for American Barrick by selling the notes for around the current market price of gold. The put option built into the note allowed for investors to take a small delivery of gold at an earlier time, which would be exercised if the price of market of gold had risen, or to wait until maturity for their full delivery. American Barrick benefited from generating cash flow upfront at a known price without collateral needed, but delaying delivery of the tangible asset until a later time.
Spot deferred contracts are forward contracts with multiple delivery dates that allow the seller of the contract to roll over delivery in one-year increments if the spot price rises above the contracted price. These contracts generally had terms of 3 to 4 years for the longest term that final delivery could take place. However, with American Barrick's large reserve base and strong financial position, they were able to extend the period of these contracts to be as long as 10 years in many cases. Spot deferred contracts are an effective method to manage price risk associated with volatility. If the spot price of gold rose above the price stipulated in the forward contract, Barrick could defer or roll over delivery to the next year while enjoying the increased return from the currently higher spot prices. If they decide to roll over, a new forward price would be set based on the prior price plus a contango premium. If the spot price fell below the new forward price, Barrick could execute the contract and celebrate above market returns. There is a danger in this strategy, however. If gold prices were to rise year over year for a long period of time and Barrick continued to roll over delivery, each year this spot deferred contract would be further out of the money. Eventually, a company using this strategy in this scenario would have to realize a substantial loss on the contract, as the size of these contracts typically covered no less than 100,000 ounces of gold. Also, it was unclear whether or not gains or losses on the fair value of these contracts would have to be recognized in earnings each year. American Barrick did not believe they would have to recognize these potential losses in fair value in their filings, as they saw these as long-term contracts. Ultimately, if a court precedent required recognition of the changes in fair value in the current income statement, it could lead to substantial P&L volatility that could be worrisome to investors.
Hi, my name is Roxy, and I'm gonna talk about question 3. Barrick's program involved 3 major financial tools: the forward contract, options, warrants, and spot deferred contracts. Hedging gold price risk is something that gives firms like American Barrick a competitive advantage. American Barrick in the years from 1984 through 1992 transferred risk by taking equal and opposite positions in 2 different types of markets, the bearish and the bull markets. Forward contracts were started in fear of declining gold prices in the early 80s, so they would go into contracts that would specify a predetermined price for redemption. This price would be higher than the declining prices. Forward contracts are private over-the-counter transactions between 2 parties, typically for delivering 10,000 ounces of gold at a specified future time and price. This would ensure that Barrick would receive predetermined forward price even if the market gold price declined. As prices fell to equal to firms' estimated break-even points and threatened to fall even further, the company's profitability was jeopardized. American Barrick sold forward contracts to manage this situation, and they didn't expect to see a recovery of gold market. The forward sales became very costly because the firm lost the opportunity to sell at higher market price. Then Barrick started to use forward sales plus option strategies to mitigate and avoid risks price altogether since 1987. Why the firm started to use option hedging is they can benefit from the rising gold market price while still eliminated downside exposure towards the declining gold price. Unlike forwards, put options only mitigate a declining gold price risk. American Barrick could retain some of the upside potential from rising gold prices. In executing a collar strategy, the firm simultaneously bought put options and sold call options on gold. There's no cash outlay since the premiums are equal in size, and it is more acceptable to the board of directors of American Barrick. As prices declined, it lowered the call strike price and the put-call ratio of call strategy so as not to allow its floor level drop. They need to maintain the put option strike price while lowering the call option strike price, surrendering upside benefits in order to eliminate the downside risk. But the option contract's time horizon is too short compared to the 20 years expected production currently in reserve. Thus, the firm began to use spot deferred contracts extensively since 1990. Spot deferred contract was a type of forward sale of gold, and the advantage is SDC seller could choose on which of these rollover dates it will deliver the gold and has the right to defer the delivery until the end of the contract. The key to make it successful is to deliver the gold when the price is low. Barrick increased the time span to a much wider range in order to ensure much of their production from a single mine was covered under some type of hedging program. However, if Barrick's finances weakened or its reserves deteriorated, its ability to roll over could be suspended. The advantage was to be able to set a minimum price on their gold that was not related to the spot price. Also, to be able to profit from higher prices. The major benefits of this spot deferred contract is that company could choose their intended minimum price and then negotiate it with the buyer. They could also sell gold when the market price was extremely high, allowing them to benefit from the highest prices.
Now we're going to take a step back and take a more broad look at Barrick's success and one of the major contributors to that success, luck. Luck in acquisitions and hedging played a significant role in American Barrick's profitability throughout the firm's life. Several of the mines acquired by Barrick produced substantially more gold than was expected. The most notable of these acquisitions was the Gold Strike mine in Nevada, which was originally believed to contain gold reserves of 600,000 ounces. After the acquisition of the mine in 1987, Barrick uncovered more gold deposits, and by 1992 the total reserves of the mine stood at 20.1 million ounces with annual production of 1.1 million ounces. For Barrick's hedging practices, luck came in the form of falling gold prices at the end of the 1980s, which led to substantially higher profits for Barrick than for its competitors. Because Barrick was able to sell gold at around $430 per ounce from 1989 to 1992, it out-earned its unhedged competitors, who were selling at an average of around $370 per ounce for the same 4-year period. Had gold prices trended up during these years, the story may have been different for Barrick. While SDCs made it possible for Barrick to enjoy the benefits of short-term uptrends in gold prices while still staying hedged against the downside, Barrick was still relying heavily on options during this period, which did not provide the choice of deferring delivery. Although the collar strategy did allow for some upside benefit, large price increases would have been far more beneficial for competing firms that were unhedged. Barrick's hedging strategy was initially attractive only to risk-averse investors, who did not want to participate in the huge price swings in the 1980s. In the late 1980s, Barrick's hedging strategy became attractive to all investors, as Barrick was consistently selling above the ever-falling market prices. There was likely a flood of investors into the stock during this time. Had prices trended up, those same investors would have chased the gains at the other mining companies, and Barrick would not have enjoyed the same stock price inflation or fame that it did. One should not entirely discount the hedging program at Barrick simply because it might not have worked out as well as it did. The purpose of the program was to reduce volatility in earnings so that investors would know what to expect. This played out exactly as planned and would work in reverse as well. An understood negative with hedging is not enjoying the upside benefits. New hedging techniques such as the SDCs discussed previously allowed Barrick to better participate in upward price trends in the future while still enjoying some downside protection. Although Barrick's hedging strategies contributed to the firm's success in the late 1980s and early 1990s, it is unlikely that hedging strategies will add as much to the firm's value as they did in the past. Not only is it unrealistic to assume that Barrick will be able to continuously sell gold at above market prices, but further expansion of hedging practices by other firms in the gold mining industry would reduce Barrick's competitive advantage achieved by hedging.
American Barrick originally established its hedging program to moderate its exposure to gold price swings and to make its future cash flows easier to forecast and be known. As the firm's mission is to maximize the value of its stockholders, this strategy looks attractive during the down times, but notably less valuable during the time of prolonged rise in the gold price. The key to running an effective hedging program, as shown by American Barrick's failure, is to realize that although you are not profiting from the extended rises in the gold price, a hedging program also protects the firm from the downside risk. If American Barrick were to have properly hedged during the mid-2000s, it's likely that American Barrick's stock price would have remained at a level much higher than it is today due to minimized exposure to the precipitous fall in gold prices starting in 2012. In a business as volatile as the gold industry, it is necessary to maintain hedging practices even in a rising price environment due to the ever-present possibility of a drop in gold prices. Similarly, as American Barrick wilted to the demands of market investors who wanted exposure to all the upside potential of gold price, the company left behind its main principle, which was to maintain conservative financial policies and to moderate the firm's gold price exposure. In doing so, the company shed almost 50% of its market value within a year.
American Barrick's investor base is made up of risk-averse investors, those who do not want to participate in the volatile price of gold. Although Barrick has been able to enjoy some benefits from unhedged price increases, an unhedged drop would be devastating not only to Barrick's cash flows and operations, but it would likely also drive away Barrick's primary investors, who would no longer be comfortable with an unpredictable holding. Given that hedging is and has been a key business strategy at Barrick, it would be unwise to discontinue this strategy in the peaceful, low volatility environment at the end of 1992. We discussed previously that future hedging practices are not likely to be as beneficial for Barrick as they have been in the past. As gold prices are unlikely to fall much further than the 1992 level, Barrick will not receive the same benefit in the next few years as they did in the late 80s and early 90s. Further expansion of hedging programs at other firms will also decrease the advantage given to Barrick by these strategies. However, gold prices are notoriously unpredictable, and protection against potential decreases remains of utmost importance even at this low gold price. The fact that we foresee other companies furthering their hedging practices should also be an incentive for continued hedging at Barrick, as discontinuing these practices could allow Barrick to lag its competitors and appear as a more risky firm instead of a less risky firm. Furthermore, as many analysts do not expect to see a rise in gold prices, we see no valid argument against hedging the increased gold output. This concludes our analysis of American Barrick Resources Corporation. If you would please direct your attention to the discussion board, we have 4 questions aimed at furthering conversation of Barrick's position and outlook.